Ladies and gentlemen, good afternoon, everyone. It's a great honor and pleasure to welcome you all to this celebration of the 10-year anniversary of the founding of the Principles for Responsible Investment, PRI. And I'm really encouraged and honored that so many could join us for this occasion today. So, people say that there is nothing more powerful than an idea whose time has come. And I think the history of the PRI over the last 10 years has been one of an idea, the idea of responsible investment, that has been embraced with extraordinary enthusiasm by the investment community. And as we celebrate the PRI's 10-year anniversary here today, we have an opportunity to reflect on how the idea of responsible investment has changed over the last decade, what we have learned, and what's next. I think one important reason for its success is that responsible investment has been framed as an investment issue, not just an ethical choice or as a moral calling. The 20 pension funds, foundations, and other institutions that drafted the original principles in 2006 were visionaries for their time and were clear in their aims. As UN Secretary General Kofi Annan said at their launch, the principles provide a framework for achieving better long-term investment returns and more sustainable markets. At the heart of the principles and underpinning the mission of the PRI is the view that taking appropriate account of environmental, social, and governance factors helps investors manage risk and generate higher returns over the long term. It really is as simple as that. It is a proposition that is backed up by extensive academic research. And that, in turn, makes responsible investment a fiduciary responsibility. When you manage other people's money, you have an obligation to consider factors that are likely to have a material impact on risk and return over the longer term. How we organize society, run our companies, and manage our investments change over time. Take attitudes to health and safety standards in manufacturing industry. Today, strong health and safety standards with the policies and procedures to deliver them are considered fundamental to how a modern company does business. High performance in health and safety is a good indicator of the quality of management in general, leads to fewer disruptions in production, higher efficiency, lower legal risk, and higher employee satisfaction. Health and safety has moved from being regarded as an extra cost to being regarded simply as a better way of doing business. And just like high standards in health and safety has become a way of doing business for the most successful manufacturing companies, high standards in the integration of environmental, social, and governance factors in decision-making will become a way of doing business for successful businesses in the financial sector, not a nice-to-have add-on activity. Eventually, we will simply lose the R from RI. Responsible investing will just be investing. But this happy day will not deliver a responsible investment nirvana where all problems are solved. There are some fundamental problems in the structure of modern capitalist societies that require investors to take a broader view of their role and work to address some of the systemic challenges that we face. As a starting point, let's consider the relationship between the owners and managers of companies. The creation of the Dutch East India Company in 1602, a little over 400 years ago, is an important milestone in economic history. For the first time, we had a company with a separate legal personality, limited liability, and shares that were freely tradable on a stock exchange. This greatly increased the ability of investors to spread and manage risks and made it possible for a relatively small country in Northern Europe to build a vast overseas empire financed by private savings. Now, finance textbooks teach us that diversification offers investors a free lunch. In theory, it then allows them to increase risk-adjusted returns. But practice shows us that it comes with a cost, namely a loss of control over their investments to company managers and a pooling of ownership with other providers of capital. This raises profound questions over how investors holding small fractions of hundreds or even thousands of companies might best monitor, incentivize, and hold to account the managers of companies that they own without resorting to counterproductive micromanagement. Investors have struggled with this issue for over 400 years now. Recent history is littered with examples of managers criminally seeking to enrich themselves at the expense of their shareholders. But even when managers may not have behaved criminally, there are serious questions to be asked of how their incentives have become misaligned with the interests of investors. Do we risk incentivizing company management to neglect the long-term health of companies they run in the pursuit of quarterly earnings targets? Or worse, simply in their own interests? The global financial crisis was also, among many other things, a manifestation of these principal agent problems. Across the entire financial system, traders were incentivized to deliver short-term returns with little regard to the long-term management of the risks that accumulated. Modern corporations, and the Dutch East India Company was the first of this kind, is perhaps the single most value-creating invention in economic history. They allow investors to pool resources and manage risk while undertaking activities of a scope and scale that would be unthinkable in smaller, privately held companies. But they come with a range of inherent issues related to asymmetric information, incomplete contracts, and principal agent problems that in many ways are hardwired into our economic systems. These issues will never go away, but they can and should be managed through high standards of corporate governance and more attention by investors to systemic issues, issues that go beyond the relationship between investors and investee companies and that relate to how markets work. We also need better dialogue among investors to ensure that they are speaking as much as possible with a common voice on issues relating to effective stewardship of the companies in which they invest. The relationship between investors and the companies in which they invest were very much front of mind for the expert group that helped draft the PRI's 6 principles. The principles call, for example, for signatories to be active corporate owners, to require ESG disclosure, and to incorporate this information into their investment processes. We can point to dramatic results in many of these areas. In 2007, in the PRI's first report on progress, around 40 asset owners disclosed that they were regularly engaging with investee companies, either directly or through investment managers or service providers. Last year, that figure had risen to almost 200. The PRI Clearinghouse, or Platform for Collaborative Engagement, has organized engagement processes with more than 1,600 companies since its launch in 2006. The PRI cannot, of course, claim all the credit for these developments, but there is one area where we perhaps can take the lion's share of the credit: the accountability of investors to their beneficiaries around responsible investment. In 2006, barely a handful of pension funds and investment managers reported on their responsible investment activities. Last year, almost 1,000 PRI signatories provided publicly available transparency reports through the PRI. With these reports, the PRI has created the world's largest database set on responsible investing practices, providing a rich source of insights and analysis. Since 2014, these reports have been downloaded more than 130,000 times. In terms of its organizational objectives, the PRI has by and large been extremely successful over its first 10 years. From those first 20 investors managing about $2 trillion, the PRI has grown to more than 1,500 signatories managing $60 trillion of assets. Of course, the PRI has had its challenges, suffered from its own growing pains, but I believe we have listened to the concerns of our signatories and worked to address these issues as they arose. While we regularly survey our signatory base, this year we also commissioned a more comprehensive assessment of PRI's progress in the implementation of the principles throughout the investment industry. We asked consultancy steward Red Queen to assess the contribution the PRI has made to increasing awareness of responsible investment globally, its effectiveness in disseminating knowledge and best practice, and our impact on the investment world and in the real economy beyond. This report was published today, and I believe you have copies of it. It recognizes that the PRI has achieved much over the last 10 years. Specifically, it has united a large proportion of the investor world around the goal of incorporating ESG issues into the investment process. It is now recognized as the global voice for responsible investment and a thought leader on ESG integration. It has become the leading platform for learning, engagement, and sharing of best practices around responsible investment. The report also recognizes some challenges: the diversity of our signatory base, the different needs that they have, and the mixed progress in terms of actual implementation by PRI signatories. The process also generated recommendation for how the PRI could better meet its objectives, deliver greater real-world impact, and better serve its signatories. The report recommends that we create more clarity and consensus around the PRI's purpose and ambition. They recommend that we prioritize more effectively and identify where the PRI can best add value. And it recommends improvements to the accountability process. The report argues that the current process is considered complex, time-consuming, and open to abuse. It also makes a case for creating more positive incentives, like a gold star type classification. This report has given us plenty of food for thought. Throughout the rest of the year, we will be consulting with signatories on the findings of this exercise, and as a part of the wider review of the PRI strategy for the years to come, a responsible investment blueprint, of which Fiona will speak later. But ensuring that the PRI is delivering to signatories the services and support they need to be responsible investors remains our fundamental purpose. It may be stating the obvious, but sometimes the obvious needs restating. The PRI is nothing without its signatories. You are the ones practicing responsible investment, ensuring that the companies you invest in are run more sustainably and with the long term in mind, using your collective influence to improve the societal value and resilience of financial markets. The last 10 years have shown us that there is strength in numbers. The weight of our signatory base has enabled the PRI to become the global voice for responsible investment. It has provided the resources to create a global platform for learning, collaboration, and engagement. Our signatories also make us uniquely placed to work with others around the world who share a common vision, such as the US CIF here and ICGN at a global level. At this occasion, I'd also like to take a moment to thank several signatories in particular: AXA, Bloomberg, Clearbridge Investments, Deutsche Bank, and South Pole Group. Without their generous support, our gathering today would not be possible. As I've already noted, the principles were drafted 10 years ago, with the relationship between owners and managers very much front of mind. Of course, this relationship remains central to the realization of the PRI's mission. But, and especially since the global financial crisis, wider systemic concerns should also be taken into account. The global financial crisis has raised profound questions about the role of investors in ensuring the health of the financial system. It is no longer sufficient that it is able to deliver short-term returns with little regard for the accumulation of longer-term risks. How the responsible investment community might rise to this challenge will be an important topic for the PRI in the months and years ahead. Another important topic for the organization will be how the PRI measures success and quantifies its impact. The preamble of the principle states that applying these principles may better align investors with broader societal objectives. This strongly suggests that responsible investors should seek to deliver measurable outcomes that are in line with wider societal objectives on economic growth, social progress, and environmental stewardship, perhaps as set out last year in the Sustainable Development Goals. As we will debate in a panel session shortly, is it time for responsible investors now to demonstrate real-world impacts? What should those impacts be, and how should they be measured? We've come a long way in the 10 years since the PRI was launched. In another 10 years, I think many of the arguments we're making now about the relevance of ESG issues and responsible investment approaches to good investment practice will have been won. How we get from here to there will involve a lot of hard work and a lot of debate, and some of which we can start here today. So it is with great pleasure that I introduce our first discussion. Michael Bloomberg is known to everyone. He built a global financial information giant by meeting investors' need for timely, accurate, and complete information. He's also built a political career in part on his concern for the environmental and social consequences of modern-day business. So it comes as no surprise then to see the great personal and professional interest Michael Bloomberg has taken to ensure investors have access to the ESG data they need to invest sustainably and for the long term. As former chair of the Securities and Exchange Commission, Mary Shapiro has championed higher corporate governance standards and better disclosure for investors for more than a decade. Upon her departure from the SEC, President Obama praised her leadership, saying that the organization became stronger and the financial system safer and better able to serve the American people thanks to her hard work. Michael now chairs, and Mary serves as a special advisor to, the Task Force on Climate-Related Financial Disclosures, whose scoping and analytical work to date culminated with the release of a formal Phase 1 report on April 1st. The PRI is keen to support the work of the task force as the year unfolds, and Michael and Mary are here today to share what the group has learned in recent months and what this means for investors. And leading that conversation will be Global Head of Sustainable Business and Finance at Bloomberg, Curtis Ravenel. So with that, I thank you for your attention. I'm really, really happy to see you. I hope that you will enjoy this afternoon's program, and I welcome the panelists to the stage. Thank you very much.